They threw everything at it. For weeks, the banks watched the physical silver market tighten like a noose around their necks, and on December 17, 2024, they made their move. Margin requirements increased. Paper contracts flooded the COMEX. Sell orders hit the tape in coordinated waves designed to break momentum and trigger stop losses across every major exchange. But when the smoke cleared this morning, December 21st, something unprecedented happened. The dealers, the actual businesses that sell physical metal to retail investors, started freezing sales, not raising premiums, not delaying shipments, freezing sales completely. SD Bullion, JM Bullion, APMEX, the largest precious metals dealers in North America, began suspending silver product listings or marking inventory as unavailable, even as their websites stayed online. This is not a technical glitch. This is not a shipping delay. This is the physical market dislocating from the paper price in real time, and if you understand what's actually happening right now, you're watching the opening act of the supply crisis we've been warning about for 18 months. While the media focuses on Bitcoin hitting new highs and the Federal Reserve's latest rate decision, the real story is unfolding in the unsexy, overlooked corner of the commodities market that Wall Street thought they had under control. They want you to believe silver is just another industrial metal. Abundant, replaceable, boring. That narrative is a lie of omission so massive it borders on criminal negligence. Here's what they're not telling you. The global silver market operates on a structural deficit of approximately 184 million ounces annually, according to the Silver Institute's latest report. That means demand exceeds mine supply by nearly 20% every single year. The gap gets filled by recycling and above-ground stockpiles. But here's the kicker. Those above-ground stockpiles are now being drained at an accelerating rate, and the largest physical dealers just blinked. When dealers freeze sales, it means one of two things. They can't source metal at current prices, or they know the price is about to gap higher, and they refuse to sell into what they perceive as a pricing error. Either scenario confirms the same underlying reality. The physical supply chain is broken. The float, this is the metal available for immediate sale, not total inventory sitting in vaults, has evaporated. This isn't theoretical anymore. Right now, today, December 21st, if you try to purchase 1,000 ounces of physical silver from major dealers, you'll encounter one of three scenarios. The product page shows out of stock. The premium has spiked to $6 to $8 over spot, compared to the normal $3 to $4. Or the estimated delivery date has been pushed to February 2025. Let's be clear. This is happening while the paper price on the COMEX is trading at $29.80 per ounce, down from Wednesday's high of $32.37. Do you see the problem yet? The paper market says silver is losing momentum and dropping in price, while the physical market is rationing supply and dealers are refusing to sell. This is the definition of market dislocation. And it's not just retail dealers. Industrial users are feeling the squeeze. Samsung, the world's largest smartphone manufacturer, uses approximately 28 million ounces of silver annually in electronics manufacturing, primarily in photovoltaic cells, MLCC capacitors, and 5G infrastructure components. Their procurement teams are now competing with solar panel manufacturers like LONGi Green Energy and Trina Solar, who collectively consume over 140 million ounces per year. First Solar, one of the largest thin-film solar producers, announced on December 10th that their first quarter 2025 production targets may need revision due to supply chain constraints in critical materials. They didn't specify silver in the press release, but industry insiders know. In this deep dive, we are going to expose exactly how we arrived at this breaking point, who's responsible for the supply crisis, and why the paper price suppression mechanism is about to fail catastrophically. We're going to look at the industrial demand surge that nobody on CNBC is discussing, the military applications, the solar build-out mandated by government policy, and the artificial intelligence server farms that require silver-based thermal interface materials. We're going to explain how the COMEX fractional reserve system works and why it's more fragile than at any point since the Hunt brothers crisis in 1980. We're going to show you the specific game theory trap that central banks and bullion banks have walked into, a trap where every move they make to suppress price accelerates physical demand and drains remaining inventory. And in Part 4, we're going to give you the strategic playbook for navigating what comes next, including the psychological warfare they will deploy to shake you out of your position before the real price discovery begins. This is the story of how the paper-silver market dies and the physical market takes over. This is not a drill. To understand why dealers are freezing sales right now, you have to understand the dual market structure of silver trading, a structure that was deliberately designed to allow price suppression while maintaining the illusion of a functioning market. There are two silver markets, the paper market and the physical market. The paper market is where price discovery theoretically happens. COMEX futures, London OTC forwards, ETF shares like SLV. These are contracts representing silver, not actual metal. The physical market is where real metal changes hands. Bullion dealers, industrial suppliers, refineries, mints. For decades, these two markets stayed roughly aligned because arbitrage mechanisms connected them. If paper traded too high, someone could buy physical, deliver into COMEX, and collect the difference. If paper traded too low, someone could stand for delivery, pull metal out of COMEX, and sell physical at a premium. This arbitrage kept prices honest. But that mechanism requires one critical ingredient: available physical inventory that can move between markets. Here's what changed. The COMEX registered inventory, metal available for delivery, has collapsed from over 150 million ounces in 2020 to just 38 million ounces today, December 2024. Meanwhile, open interest in silver futures remains near historic highs at approximately 190,000 contracts, representing 950 million ounces of paper silver. The ratio of paper claims to physical metal is now 25-1. Let's do the math, because this is where it gets dangerous. Each COMEX silver contract represents 5,000 ounces. With 190,000 contracts open, that's 950 million ounces of claimed silver. The registered inventory, the only metal that can actually be delivered against these contracts, sits at 38 million ounces. If just 4% of paper contract holders demanded physical delivery, the entire registered inventory would be emptied. 4%. That's not a bank run. That's a slow walk to the exit. But it gets worse. Not all of that 38 million ounces is truly available. A significant portion is already allocated to pending deliveries or held by entities that have no intention of selling at current prices. The true float, metal available for sale right now, is estimated by industry insiders to be somewhere between 15 to 20 million ounces. Now, layer on top of this, industrial demand alone consumes approximately 560 million ounces annually, according to the Silver Institute's 2024 World Silver Survey. Solar manufacturing accounts for 140 million ounces. Electronics manufacturing takes 230 million ounces. Military and defense applications, often overlooked, consume another 35 million ounces in applications like missile guidance systems, radar arrays, and battery technology for unmanned systems. Investment demand adds another 200 to 250 million ounces from coins, bars, and ETF accumulation. Total demand, roughly 800 million ounces per year. Global mine supply, approximately 830 million ounces per year. The deficit gets closed by recycling about 150 million ounces annually, but recycling can't scale fast enough to meet accelerating demand. Where does the remaining supply come from? Above-ground stockpiles, government reserves, central bank holdings. And here's the critical question. Nobody in the mainstream financial media is asking, what happens when those stockpiles are depleted? Do you see the problem yet? The paper market has created 25 paper claims for every ounce of physical metal, while industrial users are consuming supply faster than mines can produce it. This is exactly what happened in 1980, and if you understand that precedent, you understand why the current situation is actually more dangerous. In January 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt attempted to corner the physical silver market by taking delivery on COMEX futures contracts. They accumulated approximately 100 million ounces of physical silver and controlled another 90 million ounces through futures contracts. The price spiked from $11 per ounce in September 1979 to $49.45 per ounce by January 18, 1980. The COMEX and CBOT responded by changing the rules mid-game. They implemented Silver Rule 7, which restricted new futures purchases to liquidation orders only, meaning you could sell, but you couldn't buy. Margin requirements were increased from 10% to 100%. The Hunt brothers were forced to liquidate, and silver crashed to $10.80 by March 1980. Wall Street called it market stabilization. It was actually coordinated manipulation to break a short squeeze that threatened the bullion banks. But here's the difference between 1980 and today. The Hunt brothers were two billionaires trying to corner a market through financial leverage. Today, the squeeze is coming from structural industrial demand that cannot be turned off. Samsung can't stop manufacturing smartphones. First Solar can't halt production lines because silver is expensive. The U.S. military can't suspend Aegis destroyer construction because silver is tight. History is repeating itself, but this time the buyer is the entire industrial economy, and you can't change margin requirements to stop a solar panel manufacturer from needing silver. This creates a supply squeeze with no escape valve. The banks and COMEX operators used the same playbook that worked in 1980. Raise margins, flood the market with paper contracts to suppress price, shake out speculative longs, but they failed to account for one critical variable: inelastic industrial demand. When silver hit $49 in 1980, demand collapsed because most demand was speculative. When price fell, buyers disappeared. Today, approximately 70% of silver demand is industrial, and it's non-discretionary. Solar manufacturers can't substitute aluminum for silver in photovoltaic cells. The conductivity isn't sufficient. Electronics manufacturers can't replace silver in MLCC capacitors for 5G applications without sacrificing performance. The military can't use copper in missile guidance systems that require silver's unique electrical and thermal properties. Price suppression used to reduce demand. Now it just drains inventory faster while keeping industrial users buying at artificially low prices. The trap is set, and the banks are on the wrong side of it. In Part 3, we're going to look at exactly who's caught in this squeeze, what their options are, and why every move they make from here accelerates the crisis. If you're a JP Morgan Chase, HSBC, or Scotiabank, the three largest silver shorts on the COMEX, you have two choices right now, and both of them are catastrophic. Option A: you cover your short positions by buying back futures contracts, which drives the paper price higher, triggers stop losses on other shorts, and creates a feedback loop that could send silver to $50 plus in a matter of weeks. This is the classic short squeeze scenario, and it means eating billions in losses on derivative positions that were supposed to be risk-free market-making operations. Option B: you hold your short positions and pray that physical supply materializes to meet delivery demands, industrial users switch to alternative materials, or investment demand cools off before the COMEX inventory hits zero. This option only works if you're willing to bet that physics and industrial chemistry will suddenly change to make silver optional in manufacturing processes where it's currently irreplaceable. Here's what they're actually doing. They're trying to walk a tightrope between both options, covering small amounts of short exposure during low-volume trading sessions while simultaneously using algorithmic trading to suppress price during high-volume periods. They raised margin requirements on December 12th, the same playbook from 1980. They painted the tape red on December 17th with coordinated sell orders at 9:30 a.m. Eastern Standard Time, right at the New York Open, designed to trigger technical selling. But the physical market didn't follow. Dealers stopped selling instead. While the banks are trying to manage their short exposure, industrial users are in full panic procurement mode, and they're making moves that directly contradict the bank's interests. Let's talk about what's actually happening at the corporate level. On December 9th, 2024, LONGi Green Energy, the world's largest solar panel manufacturer, announced a $2.1 billion joint venture with Inner Mongolia Xingyi Mining to secure long-term silver supply through direct mining partnerships. This is resource nationalism at the corporate level, vertically integrating supply chains to bypass spot markets entirely. First Solar made a similar move in October, signing a 5-year supply agreement with Fresnillo plc, one of the world's largest primary silver producers. These aren't normal market purchases. These are long-term, fixed-price contracts that lock in supply regardless of spot price movements. And here's why that matters. Every ounce that gets locked into these long-term industrial contracts is an ounce that can't flow into COMEX warehouses, can't be delivered against futures contracts, and can't provide the liquidity that keeps the paper market functioning. Samsung, Panasonic, and Bosch, all major consumers of silver in electronics manufacturing, have quietly increased their raw material stockpiles by an estimated 40% over the past 12 months, according to supply chain sources in Asia. They're not waiting for price dips anymore. They're buying at prevailing prices and storing metal because they've done the same math we just walked through. If supply tightens further, price becomes irrelevant. Availability is the only thing that matters. This isn't just industrial demand competing with investment demand. This is industrial demand plus investment demand plus central bank accumulation plus supply chain disruptions all happening at once. It's a perfect storm, and each force amplifies the others. Here's how the pincer movement works. Industrial users lock in long-term supply contracts, reducing available spot market inventory. Investment demand increases as retail buyers and institutional funds recognize the supply shortage, putting additional pressure on dealers and COMEX inventory. Central banks, particularly in China, India, and Russia, continue accumulating silver as part of broader de-dollarization strategies and commodity reserve diversification. China added approximately 15 million ounces to state reserves in 2024 alone, though official figures are opaque. Meanwhile, supply disruptions from mine strikes, permitting delays and declining ore grades, reduce new supply entering the market. Mexico and Peru, which together account for 40% of global silver mine production, both faced significant labor disputes and environmental protests in 2024 that reduced output. Each of these forces individually would tighten the market. Together, they create a compound squeeze where the paper market's fractional reserve system can't absorb the pressure. The COMEX becomes a pressure cooker with no release valve. And the banks? They're sitting on the lid, trying to keep it from exploding, while industrial users are turning up the heat and investment demand is adding weight to the top. The lid is going to blow. It's not a question of if, it's a question of when. We are already seeing signs of this system breaking in real time. On December 18th, SD Bullion, one of the 3 largest online precious metals dealers in the United States, suspended sales on 14 different silver product categories, including American Silver Eagles, Canadian Maple Leafs, and generic silver rounds. Their website showed inventory levels at 0 across multiple weight categories. JM Bullion followed on December 19th, marking Silver Eagles as temporarily unavailable and pushing delivery estimates for remaining products to 8 to 10 weeks, compared to the normal 2 to 3 week delivery window. APMEX, the largest dealer by volume, increased premiums on Silver Eagles from $4.29 over spot to $7.15 over spot between December 15th and December 20th, a 67% premium increase in 5 days. These aren't isolated incidents. These are symptoms of a market where wholesale supply has dried up and dealers are rationing remaining inventory. The U.S. Mint reported on December 13th that Silver Eagle sales for 2024 have already exceeded 38 million ounces, the highest annual sales figure since 2015. The Royal Canadian Mint announced production delays on December 11th due to blank availability issues, industry code for silver planche shortages. So we have dealers freezing sales, premiums spiking, delivery times extending, mints reporting shortages, and industrial users signing long-term supply contracts to secure metal. The physical market is screaming shortage while the paper price is being held down through futures manipulation. The dislocation is complete. Here's what you need to understand. If you don't own physical silver already, your window to acquire it at anything close to current prices is closing rapidly. Not in 6 months, not next quarter. Right now, this week, dealers are making decisions about whether to sell remaining inventory or hold it in anticipation of higher prices. When dealers start freezing sales, it signals they believe the current spot price is mispriced, and they'd rather hold inventory than sell into what they perceive as a temporary pricing anomaly. That's a massive tell. For investors who already hold physical silver, congratulations. You are positioned ahead of Wall Street, ahead of the momentum funds, and ahead of the ETF flows that will eventually chase price higher once the suppression mechanism breaks. But here's the critical part. The volatility is about to get extreme. Not because the fundamentals are changing, but because the paper market will thrash violently as it dies. Let's be clear about what's coming. The banks will attempt one or more aggressive price smashes to shake out weak hands before they're forced to cover short positions. This is standard operating procedure. They did it in 2011 when silver hit $49. They did it in 2020 when silver broke above $29. They will do it again. The price could drop $5 to $7 per ounce in a single session on massive paper volume designed to trigger stop losses and create the appearance of failed momentum. Do not mistake manipulation for fundamentals. Strategy number 1. If you don't own physical silver yet and you want exposure, buy immediately from any dealer who still has inventory, accept the elevated premiums, and understand that delivery times will be extended. Do not wait for a price dip. If dealers are freezing sales, a dip in paper price just means the dislocation widens and physical availability gets worse. Focus on high liquidity products, American Silver Eagles, Canadian Maple Leafs, or generic 1-ounce rounds from recognized mints. Avoid collectibles, numismatics, or niche products. You want liquidity when it's time to sell. Strategy number 2. If you already own physical silver, prepare yourself psychologically for a massive volatility event. The paper price will likely test your conviction with a sharp drop designed to look like a failed breakout. This is exactly what happened on May 1st, 2011, when silver dropped from $48 to $33 in 4 days after margin requirements were increased 5 times in 8 days. If you panicked and sold, you were the liquidity the banks needed to cover shorts. If you held, you understood the game. The same test is coming. Set your mental stop loss based on fundamentals, not price. As long as industrial demand exceeds mine supply, as long as COMEX inventory continues declining, and as long as dealers are rationing inventory, the fundamentals are intact. Strategy number 3. Avoid silver ETFs like SLV for new purchases. SLV holds approximately 475 million ounces of silver, but the fine print in their prospectus allows them to settle in cash if physical delivery becomes impractical. You don't want cash settlement when the entire thesis is based on physical shortage. If you must use paper exposure for trading purposes, use futures or options where you can theoretically stand for delivery, but understand that COMEX may change rules, just like they did in 1980. Strategy number 4. Watch COMEX registered inventory weekly. This is your early warning system. If registered inventory drops below 30 million ounces, the system is in critical failure mode. At 20 million ounces, it's game over and price discovery will go vertical. Next week will be brutal, not for the price necessarily, but for your emotions and your conviction. They will try to shake you out with every tool they have. Sudden coordinated sell orders at market open to trigger technical breakdowns, media narratives about silver demand declining or substitution technologies emerging, and analyst downgrades from banks who are short and desperate. This is psychological warfare, and it's designed to make you doubt your research and panic sell into their bid. Here's how you defend against it. Write down your thesis right now. Literally write it out. why you own silver, what fundamentals support your position, and what would have to change fundamentally for your thesis to be wrong. When the price drops $6 in a single day and CNBC brings on a JP Morgan analyst to explain why silver is going back to $20, you pull out that written thesis and ask yourself, have the fundamentals changed? Is industrial demand suddenly collapsing? Did solar manufacturers find a substitute? Did COMEX inventory magically refill? If the answer is no, then the price move is noise, it's manipulation, it's liquidation, and it's temporary. They want you to panic. Don't give them the satisfaction. We are living through a historic pivot point in commodity markets, the moment when decades of paper market manipulation collides with physical reality and the laws of supply and demand reassert themselves with extreme prejudice. This isn't just about silver. This is about the entire financialized commodity complex that Wall Street built on the assumption that paper contracts could suppress physical prices indefinitely as long as nobody called their bluff by demanding delivery. Silver is the stress fracture where that assumption breaks first, because silver is the one commodity that sits at the intersection of monetary demand, industrial necessity, and supply scarcity. Gold doesn't have the same industrial demand. Copper doesn't have the same monetary demand. Silver is unique, and that uniqueness is why the market is breaking here first. Congratulations to everyone who held through the margin hike on December 12th. Congratulations to the diamond hands who bought more when dealers were still selling at $4 premiums last week. You saw through the manipulation. You understood that paper price and physical availability were decoupling. You recognize that when dealers start freezing sales, the endgame is near. And when the paper market finally breaks, when COMEX inventory hits critically low levels and industrial users are bidding against each other for remaining supply, you will be positioned on the right side of the most dramatic short squeeze in commodity market history. The physical supply is gone. The paper market hasn't figured it out yet, but it will. And when it does, price discovery will be instantaneous and violent. The trap is set, the prey has walked in, and the jaws are about to close.